Okay, dear students, let's start AFM first live revision class for the session March 2025. March 25, first live revision class. Before we start studying, I hope I'm audible to everyone. Please quickly reply. Am I audible to everyone properly? I hope so, please. Okay, that's great. That's simply great that I'm audible. Okay. Students, we are starting our AFM first live revision class, and the sequence in which we are going to revise the entire AFM is number one topic is cost of capital, and we are starting from the cost of capital. Then, inshallah, we'll go for investment appraisal, BSOP, Black Scholes option pricing model, Forex, merger and acquisition, corporate reconstruction, dividend policy. So let's start from cost of capital. And only the first two classes, time duration is going to be 1 hour, but from class number 3 onwards, the time duration of the live revision class will increase, and that it will go to at least 2 hours. So I have given answer of one question also, most frequently asked question, what is the duration of the class? Initially, first two classes, only 1 hour. After that, from class 3 onwards, I said at least 2 hours. I hope everyone knows the meaning of at least. When we say at least 2 hours, it means it can be more than 2 hours. It cannot be less than 2 hours. Okay. But the class is going to be just once in a week, that is on every Sunday. Cost of capital. Number one question, that what is the objective of cost of capital? Why do we need to calculate cost of capital? Objective. Let's see who is going to reply. Students, answer please. What is the objective of cost of capital? Why do we need to calculate cost of capital? Student, I need an answer. What is the objective of cost of capital? Any answer? What is the objective of cost of capital? Let's see. There are two answers. The answer is investment appraisal. Perfect. So the main objective of cost of capital is investment appraisal. Number one. Number two, don't forget another concept. Another concept is investment appraisal is a long-term decision. Investment appraisal is a long-term decision. When we study FM, financial management, in FM, there is one topic. The name of the topic is working capital management. In working capital management, actually, we make short-term decisions. But right now, the objective of cost of capital is investment appraisal, which is a long-term decision. Keep that in your mind, okay? Let me repeat again a very important concept I'm telling you right now. What is the objective? Investment appraisal. Investment appraisal is a long-term decision. Listen carefully, students, please. While calculating cost of capital, we never take overdraft. We never take OD. We never take overdraft in our cost of capital because OD is a short-term source of finance. And I'm going to use this cost of capital in investment appraisal, which is a long-term decision. Is this clear to everyone? Why don't we take OD while calculating cost of capital? Let me repeat the reason. The reason is OD is a short-term source of finance. And obviously, the objective of cost of capital is investment appraisal, which is a long-term decision. That is why we don't take OD in our cost of capital. Okay, now, when we say cost of capital, actually, cost of capital simply represents the cost of financing. It represents cost of financing. It represents cost of financing. Obviously, in order to make an investment, organization is going to raise finance from different sources of finance. Each source will have a different cost. That is why another name for the cost of capital is weighted average cost of capital. So simply cost of capital represents cost of financing. Now listen. Cost of capital. If your company raises the finance in the form of equity, then the cost is KE, cost of equity. When your company raises the finance in the form of debt, then the cost is KD1 minus T, that is cost of debt after tax. Student, quickly answer please. In case of debt, why do we say that your cost is cost of debt? Why we say it is after tax? Why it is KD1 minus T? Please reply. What is the logic behind that? Let's see. Because we save tax on interest payment, that's the perfect answer. Great. Why we say cost of debt after tax? Because fixed interest payment results in tax saving. That is why KD is not my cost. Our cost is KD 1 minus T because interest payment results in tax saving. Third, preference shares, not seen in any past paper, but still you have to have the knowledge. Preference shares. If your company raises the finance in the form of preference shares, then the cost is KP, cost of preference shares. Okay. We will discuss how do we calculate KP when your preference shares are redeemable and when your shares are irredeemable. In both the cases, calculation of KP is different because preference shares can be both, can be redeemable, can be irredeemable. In both the cases, the KP calculation is different. Okay, now, if your company raises the finance in the form of equity, then the cost is KE. What are the methods, what are the models available to calculate KE? One is CAPM, capital asset pricing model. The second is dividend valuation model, dividend growth model. Third, preposition 2, that is plus tax equation. Plus tax equation. And let me tell you one thing. In our live revision class, we will also discuss the change which they have introduced in AFM in plus tax equation. The rearranged formula of preposition 2. I've already made the videos as well. The videos are available in Urdu as well as in English on my YouTube. But I'm just telling you, we will be discussing this rearranged formula in a live revision class. And in the live revision class, we will be discussing this rearranged formula on OneNote as well as on the spreadsheet Excel. Okay. So basically, KE can be calculated by using CAPM, DVM, MM plus tax equation. Right now, I'm just giving you one important concept. Keep that concept in your mind. Later on, I need that. Listen carefully. MM plus tax equation. MM plus tax equation is the alternative for CAPM. Repeat. MM plus tax equation is the alternative for CAPM, capital asset pricing model. Now listen carefully. The situation where, let's say, you need to apply the beta approach, but data is not given enough. And let's say we need beta. It is not given to us. It cannot be calculated. Then you will have to go towards MM plus tax equation. When this will arise, how we will study each and everything. Don't worry at all. Right now, the main concept, just keep one thing in your mind, that is MM plus tax equation is the alternative of capital asset pricing model. Okay, now CAPM. By using CAPM, we can calculate K. CAPM is capital asset pricing model. Capital asset pricing model. K is equal to RF plus RM minus RF and then equity beta. K. Cost of equity. Now listen carefully, please. It is cost for the company. KE is the cost for the company. But same thing is return for the shareholders. Another name is minimum return required by the shareholders. Now listen carefully. Just for the sake of knowledge, I'm telling you one thing. K is the minimum return required by the shareholder. Just for example, assuming the K is 10%. And let's say actual return, shareholders are getting 13% from the company. Assuming actual return in the form of dividend and capital gain, shareholders of this company, they are getting, let's say, 13%. If this is the case, where K is 10%, actual return shareholders, they are getting 13%, more than the K. It means that shareholders' wealth will increase. But if K is 10% and the actual return is less than 10%, then we'll say no. Now wealth will reduce because they're not getting even the minimum return. Actual return means, let me repeat, the return shareholders they are getting in the form of capital gain and dividend. Now, RF, risk free rate of return. RF is the risk free rate of return. Simply, it has it means you have made an investment which is risk free. And in financial management, the benchmark for the risk free investment is government bonds. If your company is making investment in government bonds, then investment in government bond is treated as risk-free investment. That is the benchmark for the risk-free investment. What is the logic behind that benchmark? The logic is normally governments, they do not collapse. Please listen carefully the explanation. What did I say? Normally governments, they do not collapse. I'm not saying governments, they don't collapse. We have seen there are so many governments, they did collapse in the past. I'm saying normally governments do not collapse. That is why the benchmark for the risk-free investment is investment in government bonds, RM. Now, RM is the average return at a stock exchange. Average return at stock exchange. If it is needed, it will be given to you in your paper. Because the calculation of RM is not in our syllabus. So RM is, if it is needed, obviously it will be given to you. Now listen. RM minus RF. This difference is also having a technical name. RM minus RF. The name is equity. Why did I write equity? Because if you buy the shares of any organization, so you will become equity holder. Equity, risk. Why risk? Obviously, after making an investment in XYZ company's shares, you will face the risk. Then premium. Actually, premium means over and above something. So obviously, without taking any risk, if, for example, RF is 6%, RM is 10. So what is the reason for me to make investment at a stock exchange? The reason is additional 4%. Because without taking any risk, I can generate 6%. So why do we have a name equity risk premium? When I'm going to buy shares of XYZ company, obviously I'll become an equity holder. After buying the shares, I will face the risk. If you don't trust on that, then you should buy shares of XYZ company. Then automatically you will get to know that after making investment, investor, they do face risk. Premium means over and above something. Obviously, if I'm making investment at a stock exchange, I'll be expecting the return more than RF. It has another name as well. That is market risk premium. Market risk premium. Now, we are left with equity beta. Before developing any understanding regarding this equity beta, you just need to have a really good understanding of the beta. When we say beta, beta is a measure of risk. Beta is a measure of risk. When we say risk, there are two types of risk. Systematic risk. Another is unsystematic risk. Okay, students, please, I need an explanation. What do you mean by unsystematic risk? Please reply. What do you mean by unsystematic risk? What do you mean by unsystem? Let's see the answer. Yes, great. Unsystematic risk is a diversifiable risk. Diversifiable risk. Basically, unsystematic risk is a diversifiable risk. This is the risk which can be spread, reduced, even it can be eliminated. For example, instead of making the entire investment only in one organization's shares, you should be making investment in different organizations, companies' shares. If you are doing this, it means you are reducing your unsystematic risk. So simply do not put all of the eggs in one basket. Now listen carefully. Unsystematic risk is a diversifiable risk. Now there's a concept. Listen. CAPM assumes that investor is having a well diversified portfolio of investment. Investor is having a well diversified portfolio of investment. That is why in capital asset pricing model, we assume unsystematic risk is zero. Now, practically either it is zero or not. But when it comes to capital asset pricing model, there is an assumption. One of the assumptions in CAPM is investor is having a well diversified portfolio of investment. That is why unsystematic risk is zero. Now, we are left with systematic risk, not a diversifiable risk, not a diversifiable risk. You cannot diversify this risk. For example, if your government increases the interest rate, I cannot bring it down. Another example could be, for example, if your government increases the tax rates, so we cannot do anything. These are systematic risks. In fact, environmental issues, they have also become now systematic risk. Okay, now let's come here. No, please. We will discuss business and financial risk. Right now, you just need to look at the examples of systematic risk. Obviously, interest rate, tax rate. Government of, let's say your government increases the interest rate. So your business will suffer, no doubt about it. If the government increases the tax rates, so obviously your business will suffer. If there is uncertain political environment in your country, so it is a systematic risk for you and your business will suffer. So obviously you can say that they are contributing as my business risk factors as well. Increase in inflation rate also works as a systematic risk. Of course, I cannot decrease the inflation for me. So systematic risk, they are basically the risk which you have to just face. You cannot control them. Now, come here. Equity beta. Equity beta is a measure of systematic risk. Students, why I have written systematic risk? Why not unsystematic? Please reply. Why only I have written systematic risk? Why not unsystematic? I need answer. We are saying beta equity is a measure of systematic risk because unsystematic is zero. Yes. In capital asset pricing model, actually, we assume investor is having a well diversified portfolio of investment. That is why unsystematic risk is zero. So we are left with only systematic risk. So beta equity is a measure of systematic risk, which indicates that how your investment will respond to the changes in a stock index. Basically, when a stock index increases, then obviously your investment value will increase. Now, try to understand. For example, let's say stock index has increased by 1%. And assuming your investment has increased by 2%. Now try to understand. There's a rise at stock index, the rise is 1%. But rise in your investment is 2%, more than the stock index. If this is the case, it means that your investment is more riskier than the market. The question is why my investment is more riskier than the market? Because Your investment is generating the return more than the market. So always remember one point. When your investment is giving you the return more than the market, it means if there is going to be a downfall at the stock exchange, then you will bear the loss more than the market. So whenever there's rise in your investment is more than a stock index, it means your investment is more riskier than the market. Yes, return is higher. Obviously, return is higher. So always remember one thing. When you are generating more than the market, if something goes wrong in the market, so you will bear the loss more than the market. Got it? So if the risk is higher, return is higher. The risk is also higher there. Okay, now come here. Quickly, I need answer. Okay, a very small data. Then two objectives of the data which I'm giving you. One is a very simple calculation. I want everyone to perform. The second is interpretation is more important. Let's say RF 7%, RM 15. Number one, equity beta 0. Equity beta 0.8. Equity beta 1. Students, I need 4 Ks. Please quickly reply. I need 4 K. Let's see what are the answers. Okay, students are replying. Okay, great. Let's go by one. Number one, beta equity 0. Now please listen the interpretation properly. Equity beta 0 means you have made an investment which is risk free. Equity beta 0 means we have made an investment which is risk free. Students, if I have made an investment which is risk free, then logically KE will be equal to RF. So in number one, you can see that K is equal to 7%, 15 minus 7, and then 0. This will become 0. So K is 7%. Number two, when equity beta is less than 1. Now listen carefully. When equity beta is less than 1. When equity beta is less than 1. It means that your investment is less riskier than the market. Repeat. When equity beta is less than 1. What is the interpretation? The interpretation is your investment is less riskier than the market. Can I say when my investment is less riskier than the market, then I'm going to demand the return lower than the market. Always when beta equity is less than 1, always KE will be less than RM. Let me repeat the interpretation. Beta equity less than 1 means the investment is having the risk less than the market. If my investment is less riskier than the market, then I'm going to demand the return lower than the market. Now listen carefully. Even in exam, even in the past paper, you are solving a question, okay? And let's say the given equity beta is less than 1, then it should be in your mind that final answer of the KE must be lower than RM. Must, okay? Now let's apply. K is equal to 7%. RM is 15. 7. Equity beta is 0.8. So K is equal to 7% plus Obviously, 15 minus 7, I'm getting 8 into 0.8, 6.4. So I'm getting 13.4%. Students, you can see that even though the RM is 15, but K is 13.4. Third, beta equity is equal to 1. Now listen carefully. Beta equity is equal to 1 is a benchmark beta. Benchmark beta. The interpretation is systematic risk of investment is actually equal to the systematic risk of market stock index. Actually, the risk of investment and risk in the market both are equal. Can I say if I'm facing the same systematic risk which is in the market, if my investment is facing the same risk which is in the market, then K will be equal to RM. So whenever equity beta is 1, it's a benchmark beta, means your investment risk, obviously we talk about systematic risk, is equal to the market systematic risk. Let's apply. K is equal to 7%, 15 minus 7, and then obviously 1. So logically 7, it will become 8, and the final answer is 15. So you can see that Ke is equal to RM. Fourth and the last. In entire AFM students, either the equity beta could be 0, less than 1, equal to 1, greater than 1. That's it. There is no other option with the examiner. Fourth, equity beta is more than 1. It means your investment is more riskier than the market. Equity beta more than 1. It means your investment is more riskier than the market. Now listen carefully. When my investment is more riskier than the market, then I'm going to demand the return more than the market. Then I'm going to demand the return more than the market. So whenever you are solving a question of a past paper, or let's say a future paper, and you in the question equity beta is more than 1, then you should be mentally prepared that your final answer of KE must be higher than RM. Now let's apply. K is equal to 7% plus 15 minus 7. What is the equity beta? 1.75. Let me use the calculator. 7, then 14. KE I'm getting students 21%. You can see that equity beta is more than 1, so KE is more than RM. Now listen and listen carefully, please. If someone asks you a question, what is the interpretation of KE from CAPM? We know that KE is cost of equity. We know that KE is the minimum return required by the shareholders. But now listen carefully. Actually, can I say KE from CAPM? Actually, KE from CAPM depends on the equity beta. We have seen when equity beta was 0, KE was equal to RF. When equity beta was less than 1, KE was less than RM. When equity beta is equal to 1, KE is equal to RM. When equity beta is more than 1, KE is going to be more than RM. It means that KE from CAPM relates to the systematic risk of investment. KE from CAPM relates to the systematic risk of investment. Okay, now let's go ahead. The second model for calculating KE is DVM. Dividend valuation model, dividend growth model. By using dividend valuation model, you can calculate KE also. What is the formula? K is equal to D naught 1 plus G P naught plus G. Okay, now one by one. K is equal to, we know that K is the cost of equity. Another interpretation is slash minimum return required by the shareholders. Minimum return required by the shareholders. D naught current dividend per share. Current dividend per share. G, that is annual dividend growth rate. And listen carefully, students. In dividend valuation model, we assume that annual dividend growth rate is constant. In dividend valuation model, we assume that annual dividend growth rate is constant. P naught, current share price, ex div, excluding dividend. P naught is the current share price which is ex div excluding dividend. Now listen carefully. Whenever current share price is given, nothing is mentioned, then we assume the given share price is excluding dividend. So whenever share price is given in the question and nothing is mentioned, we will assume that given share price is ex div, excluding dividend. If examiner gives you the cum div price, cum div means including dividend. If examiner gives you the cum div price, then cum div will be written in the question. Nothing is mentioned, then we assume given price is excluding dividend. Obviously, if cum div price is given, then you have to deduct the dividend from the cum div to make it ex div. Okay, now listen carefully. The question is why in dividend valuation model we are not using cum div price, why we are using ex div price? Listen carefully. Actually, the cum div prices, they do not exist throughout the year. Repeat. At a stock exchange, cum div prices, the prices including dividend, they do not exist throughout the year. Actually, cum div prices, they exist only for few days. Let's talk about 45 days. So cum div prices, they do not exist throughout the year. Throughout the year, prices are excluding dividend. So why we are not using cum div price? Because cum div price just exists for few days, not throughout the year. And now please remember, at the start of the class, we did discuss the objective of cost of capital is investment appraisal. And investment appraisal is a long-term decision. Can I say cum div is not this cum diff price does not exist throughout the year. So how can I use that price? So normally at a stock exchange throughout the year, the prices will be X diff. That is why we use X diff price. And one more thing, please do not make mistakes which are not tolerable by the examiner. Look at the formula. Whenever you are using this formula, listen carefully. KE will be greater than annual dividend growth rate. By using dividend valuation model, if you are getting KE less than the annual dividend growth rate, it means you have made the mistake. Nothing is wrong with the question. Please look at this. We are adding this growth rate. Never make mistake. KE will always be greater than annual dividend growth rate. It cannot be less than that. If it is coming less than that, it means you have made a mistake, not the examiner. D naught 1 plus G is equal to D1. That is next year expected dividend. It is exactly the next year expected dividend. For example, if it is D24, then 1 plus G will give us D25. So simply if it is Dn, 1 plus G is equal to, it will give us D n plus 1. So basically D naught 1 plus G is equal to D1. D1 is the next year expected dividend. If it is D24, then 1 plus G will give us D25. If it is Dn, then 1 plus G will give us Dn plus 1. Okay. Just a very small question. I want everyone to attempt this. Current dividend, $2 per share. Current share price, cum diff 20. Annual dividend growth rate 6%. Students, I need KE. Please quickly answer. And logically, the KE must be more than 6%. KE must be more than 6%. KE must be more than obviously 6%. So what is the answer? Students, KE. By using dividend valuation model, let's see what are we getting. One student is saying 6.16. What about others? One student has answered 6.16. What about others? So KE is equal to current dividend is 2 into 1.06 okay students, plus 0.06. What should I write in the denominator? Should I write 20 or 18? Students, what should I write in the denominator? Should I write 20 or 18? 18. Why we are writing 18? 18 is the correct answer. Now my question is why we are using 18? Examiner has given us the cum diff price minus the dividend. You are getting X diff. So we have to use excluding dividend price. Let's see what I'm getting. 2 multiplied by 1.06 divided by 18 plus 0.06 into 100. Students, K is coming 17.0. 0.77%. Please check yes or no. Or you can make it 17.78. Or even 18% is acceptable. Now, student, listen carefully. If you have been given dividend for more than 1 year, how do we calculate annual dividend growth rate? We have to discuss that, obviously. Second, how and when to use Gordon growth model? We have to use, obviously, discuss that as well. But only one thing, obviously, it's just a first class. Now come here, please look at the formula. Where is this? Please look at this. K is equal to D naught 1 plus G upon P naught plus G. Okay, keep watching the formula, please. It is plus growth rate. If I bring this G to the other side of is equal to, can I say the sign changes? Positive becomes negative. Agreed? Can I write like this? Yes or no? Please reply. Okay, great. Keep watching. P naught is, it is in the denominator. If I bring P naught to the other side of is equal to, then it will multiply. A pure maths, P naught K minus G is equal to D naught 1 plus G. Now actually P naught is multiplying with K minus G. If I bring this K minus G to the other side of is equal to, then it will become in the denominator. So simply K minus the growth rate. Basically, obviously it depends on the data. Sometimes the examiner gives you the data. By using that data, examiner is asking you to calculate P naught. If P naught is the subject, then the formula is D naught 1 plus G upon K minus G. So by using dividend valuation model, we can calculate P naught as well. Obviously, it depends on the data, depends on the requirement. But for calculating P naught, I need dividend per share, I need annual dividend growth rate, I need cost of equity as well. For example, let's say, assuming RF is 7%, RM is 15%, equity beta is 1.2, annual dividend growth rate is 10%, current dividend per share is $2. Required is P naught. I want everyone to please calculate P naught for me. Please. You have 2 minutes to calculate. RF is 7%, RM is 15, equity beta is 1.2, annual dividend growth rate is 10%, current dividend per share is $2. What is the P naught from this data? Please. I want everyone to attempt this. Okay, one student has replied 33.33. Other is also saying the same thing. Let's try. Obviously, first we need K, RF, RM minus RF. We need K. And I'm getting K 16.6%. Yes or no, students? Please reply. Okay. Now let's go for this. P naught Current dividend is $2. Annual dividend growth rate is 10%, 1.1. Denominator KE 0.166 minus 0.1. Keep watching. 2 multiplied by 1.1. I'm getting 2.2. In the denominator, 0.166 minus 0.1. Students, I'm getting 0.066. Now we can easily calculate P naught. Students, they have replied correctly. 33.333. I hope it is clear to everyone. No, there's no percentage sign. We are calculating P naught. We are calculating current share price. There will be no sign of percentage. Only 33.33, okay? So students, as I mentioned earlier at the start of the class, since it is the first live revision class, session is March 25, only the first two classes. Time duration is 1 hour. After that, from class number 3 onwards, there will be only one Sunday. They will be off, only one Sunday. Not more than that. Only one Sunday they will be off. And that Sunday is not the coming one. Coming one, we are having a class, inshallah. So first two Sundays, simply first two classes, the time duration is 1 hour. After that, inshallah, in every class, the time duration is at least 2 hours. It can exceed 2 hours, but it will not be less than 2 hours. Okay, there's a confusion at one place. We take 7% or 7 in another. Oh, no. Please, students, come here. K is equal to, keep watching. If I'm writing 0.07 plus 0.15 minus 0.07 into 1.2. Keep watching, please. You should be really good in maths. 0.15 minus 0.07 multiply by 1.2. Keep watching what I'm writing, please. 0.07 plus I'm getting 0.096. Okay. Keep watching, please. Now add this 0.96. I'm getting 0.166. Now, to convert this 0.166 into a percentage, you have to multiply this with 100. So 0.166 multiplied by 100. I'm getting 16.6%. The same thing can be solved like that. Please keep watching. K is equal to, I'm not putting any percentage sign. I'm just writing 7. I'm just writing 15. I'm just writing 7. Then 1.2. I'm getting the final answer 16.6 and just writing a percentage sign. It is up to you. You should be really good in maths. Is this clear? Both the presentations? Please reply. It should be clear. It's just very simple. Oh, I hope it is. That's great. It is clear to you. Got it? And don't forget, there was a time when your teacher was teaching maths, okay? 2 years I taught the maths as well, but the way back, not now. So I hope, I strongly believe that everyone has enjoyed today's class. So I've also given the strategy coming class 1 hour, and then obviously timing will increase. So thank you very much, students, that you have taken time to attend the class. So thanks a lot, students, and have a nice life. Thank you. See you all, inshallah, in the next class as well. So one student is asking, what lecture should I come? No. Students, you keep watching the lectures. Pre-recorded lectures, as soon as you can complete, it's better. I'm going to, after today's classes, I'm going to give a complete note in your relevant WhatsApp group. what to do, how to approach the pre-recorded lectures, okay? Then please you have to read that note. At the end of today's my classes, I will mention that. So don't worry at all. Okay, that's great. So students, thank you very much.